Okay, hi there and welcome to a macro video. One of the features of the world economy is the persistent and large scale of trade imbalances. So let's just spend a few minutes exploring the significance of trade imbalances between some of the world's biggest economies in this short topic video. So what do we mean by the term trade imbalance? It's a key term worth knowing for your exam. A trade imbalance happens when some nations run persistent surpluses on their external trade accounts, not just from 1 year and then it changes, but persistent from year to year, whereas other countries experience persistent and often large external deficits. Let me bring into the discussion a term which you may have heard of in the news recently, the concept of mercantilism. This is actually a 19th century concept. The notion that the wealth of a nation is somehow based on how much it can export in excess of its imports. The idea being that the economic strength of a country is in some sense measured by the size of your export industries and your trade surplus. It's been applied in the modern context to those nations accumulating big trade surpluses and those focused very much on export-led growth. There's no question that there are some big trade imbalances in the world economy. These figures are for 2017 and they show that countries like Germany, Japan, China and South Korea are racking up enormous trade surpluses. They're net exporters, whereas countries such as the United States, easily the world's biggest trade deficit in terms of dollar size, the UK, India and Canada, and also countries such as Turkey are running large trade deficits. Another way of measuring this is to look at a country's current account measured as a share of their GDP. And we find that Germany is definitely in there, so too South Korea. But Singapore has the largest current account surplus of the major nations, nearly 20% of its GDP external surplus in 2018. Switzerland, Netherlands, Germany in there, Norway of course. These are all highly successful exporting countries. On the other hand, here are some countries with large external deficits, including Turkey, New Zealand and the UK. India runs a big trade external deficit, so too does Brazil. So this table I think gives us a feel and a flavour for the scale of the imbalances in current accounts between some of the world's major economies. Well, why are trade imbalances significant? What is there anything profound, important about the fact that we have debtor countries running deficits and creditor countries running surpluses? Well, here are some points. First of all, from the point of view of deficit countries, if you run a current account deficit, it means you need to run a surplus on the financial account. Basically, you have to attract foreign capital. And for some countries like the UK, that is not a problem. We're very attractive to inward investment and inflows of money into our debt and capital markets. However, it does mean that overseas investors are having an increasing claim on your country's assets, which they could desire to be returned at any time. So if you're running an external deficit, you may have to allow a foreign takeover, for example, of a major asset such as an airport or a train operating company or an energy plant, for example. And there may well be political limits to the number of domestic economic assets being bought by overseas transnational corporations. So there's a potential significance there. The second key point is that if you're running persistent external deficits, there may well come a time when a government could decide to switch away from the principles of free trade towards using protectionist policies, import tariffs, quotas, other forms of barrier to trade, allied to the rise of economic nationalism. From the point of view of the surplus countries, it's also quite significant. Typically, surplus countries, including Germany, including Japan, they're running a surplus because they're saving more than they're spending. They're exporting lots of goods and services, accumulating tens, hundreds of billions of dollars in surplus money. Not all of that money is then subsequently reinvested in their domestic economy. So there's often a surplus of savings over investment And if you think about those surplus countries as a bloc, if they were to spend more and save less, then world aggregate demand and global economic growth would be stronger. So typically, these trade imbalances have led to a rise of a global savings glut, which has kept interest rates down and which is causing a lot of friction in the world economy. They may well be choosing to keep their currency deliberately undervalued to maintain competitiveness. But if they're not spending as much as they could, then they're under consuming, and that does have an impact on living standards. Also, just focusing on exporting for its own sake means that you're allocating a large chunk of your PPF, if you like, to export sectors when they could be used productively at home. Taking the long view on Chinese trade, President Trump, of course, has often voiced his annoyance with the growing trade imbalance between the United States and China, which this chart does show. The trade deficit for the United States over $400 billion in 2018, a record high. That said, the money isn't necessarily lost to the world economy or to those businesses concerned. In many ways, it's the strong demand for Chinese goods is a result of the US economy doing pretty well. But clearly here's a trade imbalance which is causing a lot of protectionist sentiment. Indeed, since 2008, since the global financial crisis just over 10 years ago, it's the United States that has implemented most protectionist measures, nearly 800 protectionist measures, including selective tariffs, compared to the UK, less than 400, part of the European Union, of course. India has also moved towards a more protectionist stance. Germany runs an external surplus, a large persistent trade surplus. In part, that's because it's one of the most successful manufacturing countries in the world, and obviously therefore one of the world's biggest manufacturing exporters. They've run a big surplus for many years. Now normally that would cause the German currency, if it had its own currency, to appreciate. But of course Germany is part of the euro, and therefore some people argue that Germany enjoys a permanent competitiveness advantage because the euro doesn't appreciate significantly even if Germany is running a trade surplus. In that sense, Germany's trade surplus could in part be the result of a very competitive euro, which the German economy is benefiting from. Keynes would and did indeed have something to say about these big trade imbalances many years ago now, many decades ago, but he did argue that trade imbalances were difficult, they were problematic for the global economy. His point, which I think is a great evaluation point to think about, is that rather than trade deficit countries being told to cut their cloth and squeeze demand and bring down expenditure on imports, rather than deficit countries having to endure slower growth to correct their deficits, the onus should fall, according to Keynes, on creditor or surplus countries to take steps to reduce their surpluses. For example, by running a more expansionary fiscal policy. No guarantee, of course, that expansion would lead to an increase in imports from other countries, but at least expansionary policies could be tried. So imbalances often reflect structural differences in competitiveness between countries. That's natural. You're never going to get totally balanced trade. But actually, if you think about it in more general terms, those trade imbalances are often the result of big gaps between savings and investment. United States, UK not saving enough, spending too much on imports. Germany and Japan saving too much, exporting too much, in that sense, not reinvesting that money in their own economy and globally. Surplus countries, from a Keynesian point of view, could help by importing more via running expansionary policies, whereas deficit countries probably need to do more in the long term to address some supply side weaknesses to improve their competitiveness. But ultimately, trade imbalances do matter. First of all, they are a threat to globalisation, but in the sense they lead to less spending, less investment, then they're going to depress living standards and jobs and productivity in the long run. So trade imbalances in the world economy do matter. They are economically significant.